tax on the PO. We're talking GST, RCM, 194Q, and 206C1H. Welcome to The Explainer. Today, we're bringing a sharp, investigative lens to the high-stakes world of purchase order tax configurations. We're going to explore exactly why getting this stuff wrong, even slightly wrong, can be an absolute disaster for your company's bottom line. Let's dive right in. Picture this for a second. You're a buyer, you approve a massive invoice, pay the vendor in full, and, just close the file. Job done, right? Well, fast forward a year later, and boom, the government slaps your company with a massive penalty. They're actually demanding you pay the vendor's tax out of your own pocket. How does that even happen? It's simple, really. The buyer completely ignored the invisible rules of RCM and TDS on the purchase order. And trust me, that's a mistake you do not want to make. All right, in simple words, let's establish the baseline here. Standard GST is super straightforward. The vendor adds it to the bill, you pay the vendor, and then the vendor turns around and pays the government. Easy, right? But then we have RCM, the reverse charge mechanism. This is a special rule where you, as the buyer, basically bypass the vendor entirely. You just take that GST and pay it directly to the government yourself, without any middlemen. Next up is 1940Q, which you probably know as TDS. Here, the buyer actually holds back a tiny fractional percentage of the payment and sends it straight to the government, but they do it in the vendor's name. It's essentially your mechanism as a buyer for holding back the tax. And finally, 206C1H, or TCS. This one kind of flips the script. Now, the vendor is the one adding a tiny percentage to the bill to collect it from you, the buyer. To put this all into perspective, let's think about a restaurant. Normally, you pay a restaurant for your meal plus the GST, right? You're trusting them to pass that tax on to the government. Well, RCM is like paying the restaurant just for the food and then literally getting in your car and driving to the tax office to hand them the tax money yourself. Meanwhile, 194Q, it's like you're holding back a 10 rupee coin from that restaurant bill, popping it in an envelope and mailing it to the tax department with a little note saying, "Hey, just so you know, the restaurant made money today." So how does all this theory actually play out in the real workplace? Let's ground this with a real-world scenario. Meet Ria at XYZ Limited. She's in the middle of purchasing exactly 1 crore rupees worth of steel. Now, the transport company delivering that steel, they fall under RCM. So Ria steps in and configures the ERP system. She sets up the PO so the system knows to set the GST aside for the government rather than paying it out to the trucker. But wait, for the steel itself, the vendor tries to sneak in TCS on the bill. Ria knows better. She configures the PO to deduct 194Q TDS, which automatically blocks the vendor's illegal charge right in its tracks. She keeps the whole operation compliant and secure. And right here is the ultimate confusion buster. Beginners tend to panic when both parties try to apply their own tax, but here's the golden rule you absolutely have to remember. 194Q and 206C1H cannot happen simultaneously, period. By law, the buyer's 194Q is always the boss. It overrides TCS. So if the buyer is required to deduct TDS, the vendor is literally legally forbidden from charging TCS. Now, if you get this wrong, it builds into a huge risk factor. In fact, this leads us to the ultimate auditor's red flag. We call it the tax tug-of-war, where these conflicting taxes just completely clash in a company's financial system. See, auditors are actively hunting for lazy ERP configurations. They are looking for systems that actually allow a vendor to illegally charge TCS, while the buyer's system is simultaneously deducting TDS. Think about that. That double taxation, it severely drains a company's cash flow. It's just silently throwing money away. This is exactly why your master data absolutely must be strictly tested to auto-apply 194Q. Your systems have to be smart enough to reject those conflicting vendor taxes before the PO is even issued. Secure your ERP configs and stop the cash drain. Seriously, that is the critical takeaway here if you want to protect your bottom line. Thanks for joining me for this explainer, but before you go, I want you to ask yourself something. If an auditor walked in and pulled your last 100 purchase orders today, how much of your cash flow would be bleeding out through conflicting taxes? Catch you next time.